fact that a high win rate is an awful benchmark. And what you were talking about in terms of the disposition effect, it leverages that exact concept where retail traders have a disposition effect where we like to realize winning trades, which leads to us holding winners too briefly, and we avoid losing trades, which leads us to tend to allow losses to expand massively. And again, don't take Eric's word for it. This is from The Behavior of Individual Investors by Barber and Odeen from the University of California. They go through all of these things. And that is exactly what's happening with a high win rate. You get to enjoy the disposition effect, which unfortunately is not a great way to make money.
Yeah, great lessons for all of us. You mentioned earlier about expected return. What do you mean by that exactly? How can we expect a return?
Yeah, a bunch of different ways you can think about it. But essentially, expected return is a simple formula. We're going to take our average win size as $1, our average win rate as a percentage. This could be for an entire portfolio. It could be for a system. It could be for an individual trade. You can look at it in a bunch of different levels. There's obviously different drawbacks depending on what sample size you're looking at and how representative of it is of the expected outcomes going forward. But you take that side of the equation, kind of the win size, and then you look and compare it against the loss side. So your loss rate as a percentage, and then your average loss size. So at the end of this, you're essentially not just taking win rate in a vacuum, you're actually taking a couple other really important data points, your trade sizes, and then you're seeing how something can perform. And again, you can take this in individual trades. You could say, I'm trading vertical spread. I hate vertical spreads. I'm trading a short put. And in that short put, you look at either just the option probabilities or you have a probability forecasting tool. Some platforms have that. And you can say the probability of this thing expiring in the money at expiration is 30%. Okay, now we have some data that we can work with. And you can even turn this expected return concept into a non-binary outcome where it's, yes, I make full money. No, I lose full money. And you can actually adjust the math so that it's a gradient based on probabilities. And what this does is it gives you a much higher fidelity view of the performance of a strategy. So then if you want to forecast it going forward, I'm actually going through my end of year review right now. So I look at all of the different strategies that I run and I calculate the expected return for all of them. I look at those metrics for the strategies as I deploy them. And then you can run a Monte Carlo simulation if you're so inclined to forecast how it could perform the next year. Or you could look at a large data set that you build over time and continue to build on that then gives you a pretty clear picture on what works in what scenario. But for me, expected return is the guiding force. It's not win rate. I simply need to know, does what I do make money? And is it more likely to make money in the future than not? That's what I care about.
Fantastic. So to wrap up, what do you struggle with most as a trader?
I think I still struggle with risk. I think that I am too risk averse. And I think it's because of growing up with a significant amount of scarcity. I have gotten light years better at it. And honestly, if you compare me to the average person, I definitely am way more risk open than the average person is. But I still wish I was more risk open. When I talk to people like Tom Sosnoff,